Welcome back. This is the second video for Chapter 1 in your Cornerstones textbook. Now we're going to move pretty quickly in this video. We're going to spend most of our time looking at problems to make sure that you have a good understanding of the material. This PowerPoint is available on the Moodle website, and by now you should have read all of Chapter 1 in your textbook. So follow along in your textbook. I won't go over everything on these slides, but I will spend time on the problems. Okay, we're going to be covering the 4 financial statements: balance sheet, income statement, statement of retained earnings, and the statement of cash flows. On the balance sheet, which is arguably probably one of the most important statements that we can look at because it is the source of the fundamental accounting equation, we find assets on one side. That's answering the question, what does the company have? And we have liabilities and stockholders' equity on the other side. We said in the proper definitions that those represent the claims on assets in the company, but another way to understand that is simply, how did the company get all those assets? Either they have liabilities or debt, they have obligations that they owe to their creditors, or they have owners who gave them money. Okay, assets come in 2 major forms. Current assets, any assets that have a lifespan of less than a year. We include cash in this list, any short-term investments. Accounts receivable, one very important one to think about, that's any money that is owed to the company by its customers. Some companies don't take cash at the point of sale. They sometimes bill later. You know that you have received bills for things in the past where you didn't pay at the time you received the service. That means you created an accounts receivable for that company. Inventories are tangible assets that a company can have that it then resells. Those can be inventories of things it makes or inventories of things it buys to resell. Some other important current assets are what we call prepaid expenses. Certain kinds of expenses we have to pay in advance, like maybe your car insurance. You sometimes pay that 6 months in advance. You don't use all 6 months worth the moment you pay for it, right? Well, in accounting, what we do is when you pay it, what ends up happening is on your balance sheet is this asset, 6 months worth of an asset. It's 6 months worth of a prepaid insurance, for instance. Assets are also grouped into one other major category, and that's the non-current assets. Those are assets, things the company owns, that will last for more than a year. One of the major categories is property, plant, and equipment. Those are all long-term assets. Those are the things that we purchase through the investing activity. Note that all property, plant, and equipment loses its value over time, and we record that as a depreciation expense. That's on the income statement, but then we accumulate all that depreciation on the balance sheet, and we'll get into some of that later. There are also intangible assets, things like patents or the value of a trademark. These are long-term assets. They certainly last more than a year, but they are not things you can actually wrap your mind or your arms around exactly. Liabilities now are in the category of things that deal with the claims that others have on the assets of a company. Liabilities are things that incur creditors. They also can be divided into current, meaning less than 1 year, and non-current, which we'll show on the next slide. Some current liabilities to think about, almost all of them end with the phrase payable or the word payable. Accounts payable are invoices that one company owes to another company. So when you sometimes owe a company, you got an invoice for a service. Let's say someone built a cabinet for you and you have to pay them within 30 days. For you, that's an accounts payable. You have 30 days to pay them. That's a little short-term loan, essentially, they gave you. Sometimes companies incur salaries payable because they don't pay wages to their workers every hour of every day. They don't do that because it would be very, very difficult, of course, to do that. But that does mean that they are building up something that they owe to their employees. There's something called unearned revenue, and this happens when a company enters into a contract to complete a job for a customer and the customer pays them up front. Well, the company received the money, but they haven't done the work yet. and that is what we call unearned revenue. That is a short-term liability for a company. Long-term liabilities are mostly in the long-term debt category. These are the non-current or long-term liabilities, and they are things like notes payable or bonds payable. Stockholders' equity is divided into two major categories. Contributed capital is the money that comes in by selling stocks. Retained earnings is all of the income that we make and potentially keep in our company. Overall, we find that capital in a company is the right side of the balance sheet. It is all the non-asset stuff. It's the liabilities plus stockholders' equity. Remember, assets equals liabilities plus stockholders' equity, which means capital, if that is the total of liabilities and stockholders' equity, it must equal the value of assets. Now let's just test ourselves. Let's look at cornerstone exercise on 117 in the end of your chapter. In the column on the left are a series of account names. In the column on the right are the categories that we could attach them to. So accounts payable, what kind of category of account is that? Yes, it's current liabilities. Machinery, what kind of account is that? Yes, it is a long-term asset and it falls into property, plant, and equipment. Inventory. Yes, it is current assets. Common stock. Exactly, common stock is what we sell to get contributed capital. Notes payable, let's say that they are due in 5 years. That should be a clue to you. What would that be? Those are long-term liabilities, yes, because they're due in 5 years. Cash. Yes, cash is a current asset. Copyright. We can't exactly wrap our hands around a copyright, so that's an intangible asset, though. It's something certainly that has value that the company owns. Net income minus dividends. Yes, that is retained earnings. If you've been following along your textbook, you know that one. Accumulated depreciation. What category does that fall under? Yes, if you were listening closely, you know that depreciation is the loss of value to all long-term property, plant, and equipment assets. Now, it is technically a negative number. It reduces the total value of assets over time, but it does show up in the category property, plant, and equipment. Lastly, accounts receivable. Yes, these will always be due in less than a year by the customer, and since they are owed to the company, not owed by the company, they are an asset, current assets. Good job. Now, just to give you an idea of how a balance sheet tends to work, we usually have 2 years worth of information, if not 3. And we always start with the assets, and we start with the most current, and we work our way down to the most long-term, and then we total them. Look for subtotals, by the way. Things like total current assets. Now we total all the assets here, and then we move into liabilities, moving from the short term into the long term. And then what this balance sheet calls owner's equity, that is the exact same thing as stockholders' equity. We move into that, and we have contributed capital and retained earnings, and we total liabilities and stockholders' equity at the bottom. This should equal that, and it does. Now, what's the process for creating a balance sheet? Well, all of it is right here. There should always be a heading. What's in the heading? It's right in your book. You should always have the company name, the name of the financial statement, and the time period for which you are reporting. You list all the assets, starting with the most current to the least current. You list the liabilities, current to most current. List the stockholders' equity. And then you total all the assets and you total all of the liabilities and stockholders' equity, and they should equal. Let's try it. Cornerstone 1-2 on pages 14 and 15 in your book gives you this information for Hightower. How would you start this? Well, on the next slide, I show you definitely you had to provide the company name, the name of the financial statement, and the time period, which is the date, December 31st, 2011. Now take all the information you've got right here and figure out where you'd put it. Notice I already kind of set this up for you. We have assets first. Let's start with assets. We're going to move from current, the most current, which is always cash, to the least current. On this list, what are the assets? If you got something that looks kind of like this, hopefully a little neater, then you are good. Cash is the most current asset, and it's cash of $2,500. Accounts receivable, $4,200. See that over here? Inventories, $2,300 over here. If we total those all up, we get $9,000 of total current assets. Then we move to the next category, which is going to be long-term assets, non-current assets. We've got land, equipment, and over time it has accumulated depreciation of $5,800. Notice it's a negative number, $5,800, and how do you know? Because we put it in parentheses. In accounting, parentheses are a sign that something is negative. We don't use the minus sign generally. Once we're working on a financial statement, we use parentheses. So that means here it's $12,100 plus $21,000 minus $5,800 gives us a total property, plant, and equipment value of $27,300. There was only one intangible asset on this particular balance sheet, and it's patents worth $2,500. If I add up all the assets, current, non-current, and another non-current, I get $38,800 of assets. Now, before we go any further, if total assets is $38,800, what do you expect is the total liabilities plus stockholders' equity? If you said $38,800, then you are correct. Now let's fill in the liabilities and stockholders' equity. We're going to start with liabilities, current to less current, and then we move on to the stockholders' equity with contributed capital, or I'm just going to be specific here. I'm just going to call it common stock because that's how I got capital for this particular company. I'm going to start with my accounts payable. Accounts payable over here was $37.50. Let's go right over here. Salaries payable, $1,200. So the total current liabilities is this plus this is $49.50. The notes payable, I go over here and I find that notes payable were $8,100. So total long-term liabilities, since there was only one line item there, was a total of $8,100. Total current plus total long-term is $13,050. Common stock was $14,450 because that's how much was contributed via common stock to this company. And the retained earnings we found out was $11,300. My total stockholders' equity is this plus this, which gets me $25,750. If I add total liabilities plus total stockholders' equity, what do I get? Yes. It does work out. My balance sheet balance is $38,800. Now, how do we use this balance sheet? Well, we use it mainly to make sure that our accounting equation actually balances. But what else do we get out of this? We get an insight on something called liquidity. What's liquidity? Well, your book tells you that measuring the liquidity of anything is measuring its closeness to cash. So the cash in my pocket is highly liquid. The home I own is not very liquid because how easy is it to turn my house into cash? Well, that requires me listing it on the real estate market. I've got to find a buyer. I've got to make sure that they do the inspections. They're going to need to get financing. It's going to take me a while for my house to turn into a source of cash. But the cash in my pocket is really liquid because it's cash right now. What if you write me a check? Well, assuming that there's some money in your bank account, I can turn that into cash pretty quickly. So that's pretty liquid. And liquidity, it turns out, is very important to a company. It helps it pay its bills, right? So the balance sheet can give me an idea of how liquid a company is. We can find out something called the net working capital. If I look directly at a balance sheet, I can find out net working capital very quickly because all I do is find the total current assets and I subtract the total current liabilities. I generally just do this right in dollar form. So if a company has $100,000 in current assets and $80,000 in current liabilities, I find out that they have $20,000 in net working capital. Now this is a great way to look at how much working capital a company has. Except that, what if we're talking about a company that has $100,000 in current assets versus a company that has $100 million in current assets? Well, they're obviously very different sized companies, right? And how would I compare which one was more liquid than the other? Well, I would do something called the current ratio. And that is current assets divided by current liabilities. It essentially answers the question, for every dollar of current liability, how many dollars of current assets do I have to pay for it? This is a better comparison between companies because it controls for the size of a company. This will generally give you an answer somewhere between 0 and probably about 20. This concludes video number 2 for chapter 1.